Good evening. Tonight we are tracking a developing situation in global precious metals markets, one that, according to an analysis published Sunday evening, March 15, 2026, is unfolding in real time across trading floors in Asia, while North American markets remain closed for the weekend. Curious. At the center of tonight's report is a growing divergence between the paper price of silver, which closed the Friday session on the COMEX at $81.34 per ounce, and the physical price of silver currently being transacted on the Shanghai Gold Exchange, where Monday trading opened at 7 o'clock in the morning local time, corresponding to 7 o'clock Sunday evening Eastern Time in the United States. According to the analysis under review, Asian institutional buyers, sovereign wealth funds, and state-backed trading desks have been aggressively acquiring physical silver since the Shanghai Gold Exchange opened for the week. The buying activity is described as among the most aggressive physical silver acquisition seen since what the analysis refers to as the bank shocks of 2025. Premiums being paid over the COMEX reference price for 1,000-ounce good delivery bars are described as substantial, though specific figures are not disclosed in the source material. Two converging developments are cited as the primary drivers of this accelerated buying. The first is a reported disruption in the Strait of Hormuz over the weekend, which the analysis states sent Brent crude oil futures from $93 per barrel on Friday afternoon to $112 per barrel by Sunday morning. The second is the mathematical relationship between that energy price spike and the cost of mining silver, a relationship the analysis argues has rendered silver production at the current paper price economically unviable for the majority of global primary producers. Those two threads, the physical buying surge on the Shanghai Gold Exchange and the cost of production breakdown in the silver mining sector, form the foundation of tonight's report. We begin with a detailed examination of both, starting with how the Shanghai Gold Exchange operates and why its pricing mechanism differs fundamentally from the COMEX futures market in New York. The Shanghai Gold Exchange, according to the analysis, operates on a fundamentally different legal and structural basis than the COMEX futures complex in New York, where the COMEX permits participants to enter into silver futures contracts that can be rolled forward indefinitely without ever requiring the physical delivery of metal. The Shanghai Gold Exchange operates as a physical delivery settlement system. Every contract executed on that exchange, according to the analysis, must result in the actual movement of metal from vault to vault, from seller to buyer, from warehouse to refinery to end user. There is no provision within the exchange's legal framework for cash settlement in lieu of physical delivery. A participant who enters a contract is obligated to take possession of the metal, or does not participate at all. This structural distinction is presented in the analysis as the reason why premium levels on the Shanghai Gold Exchange carry meaningful informational weight. When the physical price on the SGE begins to diverge sharply from the COMEX paper reference price, the analysis argues this is not a temporary arbitrage inefficiency that will self-correct through normal market mechanisms. It is described instead as a direct signal that the Western paper price discovery mechanism has become disconnected from the physical reality of actual metal availability and actual transaction costs in the real market. According to the analysis, within the first 90 minutes of Monday morning trading on the Shanghai Gold Exchange, beginning at 7 o'clock local time in Shanghai, contract volumes for physical silver delivery spiked to levels that would typically require a full trading session to accumulate. The buying is described as consisting of institutional block orders, 50-lot and 100-lot buy programs, executed without hesitation or price negotiation. The premiums being paid over the COMEX reference price are described as reaching double-digit percentage levels, a characterization the analysis attributes to buyers who have, in its words, done the macroeconomic homework on the energy situation unfolding over the weekend. That macroeconomic homework centers on the relationship between crude oil prices and the cost of silver mining. The analysis explains this relationship in the following terms. Approximately 70% of global silver production comes as a byproduct of base metal mining operations, copper, lead, and zinc extraction. Those operations are described as energy intensive at every stage of the production process, from the diesel generators powering extraction equipment, to the crushing mills processing ore, to the smelters refining the material, to the electrolysis plants separating the constituent metals. Energy, the analysis states, is not merely one input cost among many in the mining production process. It is described as the foundational input cost underlying every stage of extraction and refining, meaning that when energy prices rise, the effect on total production costs is not linear but exponential. With that framework established, the analysis turns to specific figures from the primary silver mining sector, companies for which silver is the principal product rather than a byproduct. Citing the most recent quarterly earnings reports from named producers including First Majestic, Fresnillo, and Pan American Silver, the analysis states that the average all-in sustaining cost for primary silver miners was running at approximately $68 per ounce in late 2025. That figure, the analysis notes, was calculated when crude oil was trading in the range of $85 to $90 per barrel. With Brent crude having moved from $93 per barrel on Friday afternoon to $112 per barrel by Sunday morning, a move the analysis attributes to the reported Strait of Hormuz disruption, the all-in sustaining cost for the majority of the primary silver producer complex is described as having quietly crossed $90 per ounce. The COMEX spot price closed Friday at $81.34. The arithmetic, as the analysis presents it, is straightforward. If the cost of extracting, refining, assaying, and delivering 1 ounce of silver to a vault is $90, and the paper market is pricing that ounce at $81, primary silver producers are operating at a loss on every ounce they bring to market. The analysis acknowledges that the primary mining sector has not yet moved to mass production shutdowns, attributing this to two factors. The first is contractual obligation. Many producers sold forward hedges years ago when silver was priced significantly lower and remain bound to deliver against those contracts. The second is byproduct revenue. Operations that produce silver alongside copper, gold, and lead continue to generate positive economics from those companion metals, even when the silver price falls below the cost of extraction. However, the analysis presents the cost of production breakdown as a critical data point for the institutional buyers currently active on the Shanghai Gold Exchange. A sovereign wealth fund or state trading desk managing a multi-billion-dollar commodity portfolio, the analysis argues, can read a balance sheet and identify when a commodity is trading below its cost of production. In that scenario, the analysis states, one of only two outcomes is mathematically possible. Either mine supply contracts as producers shut down loss-making operations, reducing the availability of physical metal in the market, or the paper price rises sharply to meet the physical cost curve. The analysis concludes that in either outcome, an institution holding physical silver is positioned favorably, while an institution holding short paper contracts faces significant risk. That risk assessment, the analysis argues, is precisely what is motivating the aggressive buying behavior observed on the Shanghai Gold Exchange. And it is the same dynamic that sets the stage for what the analysis describes as a significant market event when New York trading resumes Monday morning. Turning now to the specific inventory and positioning data on the COMEX Futures Exchange in New York, figures that the analysis under review presents as the quantitative core of its argument that the physical silver market is approaching a critical stress point. The COMEX registered silver inventory represents the physical metal that is formally available and eligible for delivery against outstanding futures contracts on the exchange. According to the analysis, that figure has undergone a significant and sustained decline over the past 18 months. The registered inventory stood at approximately 280 million ounces in mid-2024. As of the most recent Commitment of Traders report filed on March 7, 2026, that figure had fallen to just under 73 million ounces. The analysis characterizes this as a 74% drawdown in deliverable inventory over a period of less than 2 years. Set against that inventory figure is the scale of outstanding paper claims on the COMEX silver futures complex. According to the analysis, open interest on those contracts is currently sitting at over 400 million ounces. The relationship between these two numbers, 400 million ounces of contractual claims against 73 million ounces of registered physical metal available for delivery, produces what the analysis describes as a 5.5 to 1 leverage ratio. The analysis characterizes this as a fractional reserve system operating in the precious metals market and describes the current state as one approaching a potential force majeure event. The analysis situates this inventory and positioning data within the context of the physical buying currently underway on the Shanghai Gold Exchange. As Asian institutional buyers absorb available physical supply at premium prices overnight, the analysis argues that the already strained relationship between COMEX paper claims and deliverable physical inventory becomes progressively more acute. Every bar of silver that moves from a Western exchange warehouse to an Asian sovereign vault or strategic commodity stockpile is described as one less bar available to settle the outstanding short interest held by hedge funds and bullion banks on the COMEX. The analysis identifies the scale of net commercial short interest on the COMEX as a central element of the market risk building overnight. Citing the most recent Commitment of Traders report, the analysis states that net commercial short interest on COMEX silver futures was sitting at over 290 million ounces as of the previous Tuesday. It is this short interest, the analysis argues, that creates the conditions for a forced covering event when New York markets open Monday morning. The sequence of events the analysis anticipates is described as follows. When the COMEX electronic pre-market session opens at 8:20 in the morning Eastern Time, the algorithmic trading systems that normally establish opening price equilibrium will scan overnight activity across related markets, currencies, crude oil, and treasury yields, and attempt to reprice silver based on correlation models that have been in operation since approximately 2008. The analysis identifies a fundamental vulnerability in those models. They are built, it states, on the assumption that the COMEX paper price and the SGE physical price represent the same underlying value, differing only by a small premium to account for shipping and financing costs, perhaps $1 or $2 per ounce in either direction. That assumption, the analysis contends, will be invalidated by the SGE settlement data from Sunday night trading. The physical transaction prices being recorded on the Shanghai Gold Exchange for kilogram bars and 1,000-ounce good delivery bars are described as reflecting premiums over the COMEX reference price that are multiples of what the algorithmic models would classify as a normal arbitrage spread. When New York market makers access that SGE settlement data Monday morning, the analysis argues they will face a margin call problem of significant proportions. To illustrate the scale of that problem, the analysis draws a comparison to the London Metal Exchange nickel squeeze of March 2022, describing the potential margin call scenario facing COMEX silver short sellers as materially larger in scope. Any hedge fund, commodity trading advisor, or systematic macro fund currently running a short silver position will, according to the analysis, receive communication from their prime broker indicating that the physical market in Asia has moved substantially higher overnight and that margin requirements have increased accordingly. Participants holding large short positions with significant leverage, the analysis references a hypothetical 70,000-ounce short position leveraged at 15 to 1, are described as lacking the liquidity and balance sheet flexibility to post additional margin against a 10% adverse overnight move. The analysis states that under those conditions, the available course of action for short sellers is to cover their positions by purchasing silver futures in the open market. When 290 million ounces of net short interest attempts to cover simultaneously into a market that has seen its physical supply drained by overnight Asian buying, the analysis argues the result is not an orderly price discovery process. It describes the expected outcome as a gap opening, potential trading halts, and a limit-up move in the silver price. A historical parallel is drawn to the events of 1980, when silver moved from $11 per ounce to $50 per ounce over a 4-month period during the period of forced liquidation associated with the Hunt brothers' silver position. The analysis distinguishes the current situation from that historical episode in one significant respect. In 1980, the Federal Reserve under Chairman Paul Volcker had the capacity to raise interest rates to 20% in order to stabilize the financial system and halt the commodity price surge. In March 2026, the analysis states, the Federal Reserve is holding rates at 5.25% against a national debt of $35 trillion that the analysis describes as unable to survive a sustained real interest rate above 3% without triggering sovereign default conditions. Beyond the immediate COMEX dynamics, the analysis extends its examination to the broader structural supply deficit in the global silver market. Citing the Silver Institute's most recent supply and demand analysis published in January 2026, the analysis states that the global silver market is running a structural deficit of 215 million ounces per year, meaning that combined industrial and investment demand exceeds combined mine supply and recycling supply by that margin annually. That deficit is currently being filled by drawdowns of above-ground stockpiles, including exchange-traded fund inventories and COMEX warehouse holdings. Specific figures cited in the analysis include the SLV exchange-traded fund, described as the largest silver-backed ETF, which held 512 million ounces at its peak in February 2021, and held 308 million ounces as of the most recent reporting period, a drawdown of approximately 200 million ounces over 5 years. The United States Mint's most recent monthly sales data is also referenced, reporting 4.22 million ounces of Silver Eagles sold in February 2026 alone, described as the highest single-month total since January 2021. The analysis also addresses the gold-to-silver ratio as a valuation metric. Gold closed Friday at $7,100 per ounce. Silver closed at $81.34 per ounce. Dividing those two figures produces a ratio of approximately 87.6 to 1. The analysis states that the 300-year historical average for this ratio sits between 55 and 65 to 1. During periods of monetary and financial system stress, the ratio has compressed significantly, reaching 15 to 1 at the peak of the 1980 silver market and 32 to 1 during the European sovereign debt crisis of 2011. The current reading of 87 to 1 is characterized as historically anomalous and inconsistent with the monetary and industrial demand pressures the analysis describes as currently active in the silver market. We turn now to the broader macroeconomic and geopolitical framework the analysis presents as the underlying context for what it describes as a historic shift in the global financial system. The analysis opens its geopolitical argument with the weekend's reported disruption in the Strait of Hormuz. The Houthi forces operating in the Red Sea and the Gulf of Aden are described in the analysis not as independent actors, but as proxies receiving coordination from Iranian Revolutionary Guard intelligence units, which the analysis further states are receiving strategic guidance from Beijing and Moscow. The stated objective of this coordination, according to the analysis, is to expose vulnerabilities in the Western energy supply chain and accelerate a shift away from dollar-denominated commodity pricing. To understand the significance of that objective, the analysis traces the origins of what it describes as the petrodollar system to 1974, when an agreement was reached with Saudi Arabia establishing that every barrel of oil traded globally would be priced in United States dollars. The analysis describes this arrangement as having created a structural and sustained demand for U.S. Treasury debt, because any nation requiring oil imports first needed to acquire dollars to purchase it. That artificial and persistent bid for the dollar, the analysis argues, allowed the United States to run large fiscal deficits for approximately 50 years without experiencing the currency collapse that the analysis contends would have affected any other nation operating under the same fiscal conditions. The analysis states that this arrangement is now under active challenge. China is described as having questioned the petrodollar framework since 2008. Russia is described as having intensified that questioning following sanctions imposed in 2014. Saudi Arabia is described as having raised the same question following the freezing of Russian central bank reserves by Western governments in 2022, an action the analysis characterizes as demonstrating that dollar-denominated assets are subject to political confiscation under certain geopolitical conditions. With Brent crude trading above $110 per barrel in March 2026, the BRICS economic bloc described as controlling over 40% of global GDP, and the Shanghai Cooperation Organization described as offering an operational alternative to the SWIFT international payment system, the analysis states that commodity-producing nations now have a viable mechanism for conducting trade outside the dollar framework, including pricing oil in Chinese yuan, in gold, or in a basket of commodities. The analysis argues that if this transition away from dollar-denominated oil pricing accelerates, the structural demand for U.S. Treasury debt that has underpinned American fiscal capacity for 5 decades would erode. Foreign central banks currently holding approximately $8 trillion in Treasury securities are described as doing so primarily because of their need for dollars to purchase oil. The analysis states that if that need diminishes, the organic demand for Treasury debt diminishes with it, forcing the Federal Reserve to expand its balance sheet to absorb bond issuance that foreign buyers no longer wish to hold, a process the analysis describes as monetary debasement by another name. This macroeconomic backdrop is connected to the specific fiscal data the analysis presents for the United States in 2026. Federal government spending is cited at $6.8 trillion annually, according to Congressional Budget Office projections, against tax revenue of $4.5 trillion, producing a deficit of $2.3 trillion. The national debt as of March 1, 2026, is cited at $35.2 trillion. Annual interest expense on that debt at the current Federal Reserve rate of 5.25% is cited at $973 billion, described as the single largest line item in the federal budget, exceeding defense spending, Social Security, and Medicare individually. The analysis characterizes this as a debt spiral, drawing structural comparisons to the fiscal crises of Greece in 2010, Argentina in 2001, and the Weimar Republic in 1923, while noting that the United States differs from those historical cases in that it controls the global reserve currency, providing the Federal Reserve with the option of monetizing the debt rather than defaulting outright. The analysis cites M2 money supply data to illustrate the scale of monetary expansion already undertaken. The M2 money supply increased from $15.5 trillion in February 2020 to $21.7 trillion by December 2022, a 40% expansion in under 3 years. As of the analysis date, M2 is reported at $20.9 trillion, having declined only marginally from its peak. The velocity of money is described as having collapsed to historic lows, with the analysis attributing this to a broad shift among large institutional investors away from dollar-denominated financial assets and toward hard assets including farmland, real estate, commodities, and precious metals. Within that hard asset reallocation, the analysis identifies silver as occupying a uniquely favorable position. The BRICS summit in Johannesburg in August 2025 is cited as a turning point, at which the economic bloc formally announced development of a commodity-backed international settlement unit designed to allow member nations to conduct trade in oil, gas, wheat, copper, gold, and silver without transacting in dollars. The technical infrastructure for that system is described as currently being developed through the Shanghai Cooperation Organization, the Asian Infrastructure Investment Bank, and the BRICS New Development Bank. Silver is identified as one of the core strategic metals in that framework on the basis of its dual role as both a monetary metal and an irreplaceable industrial input for solar panel manufacturing, electric vehicle production, artificial intelligence server infrastructure, military radar systems, and fifth-generation telecommunications networks. The gold-to-silver ratio of 87:1 is revisited in this context. Gold closed Friday at $7,100 per ounce, reflecting 14 consecutive years of net central bank purchasing globally, including 225 tons added to China's official reserves in 2025 alone. The analysis presents the argument that gold's current price reflects an accurate repricing of monetary risk associated with Western sovereign fiscal stress and dollar debasement. If that premise is accepted, then silver at $81 per ounce, implying a ratio of 87:1 against gold, is characterized as still priced, as though the global monetary system remains stable, central banks remain credible, and governments remain solvent. The analysis states that the current macroeconomic environment does not reflect those conditions. The institutional buyers active on the Shanghai Gold Exchange tonight, the analysis concludes, are acting on a game-theoretic assessment of this situation, paying a double-digit percentage premium over the COMEX reference price for physical silver delivery is presented not as irrational price-insensitive buying, but as a rational response to the calculus that attempting to accumulate physical silver gradually over a 6-month period would result in the price moving away from the buyer before the required volume could be secured. Paying the premium now, securing the physical weight now, is presented as the strategy of buyers who have concluded that the window for acquiring silver at prices in the double-digit premium range over COMEX is closing. As this broadcast has maintained throughout tonight's report, it is essential to note clearly and for the record that the analysis examined this evening originates from a single source. The projections, market characterizations, inventory assessments, geopolitical interpretations, and macroeconomic conclusions presented in that analysis have not been independently verified by this program. The figures cited, including COMEX registered inventory levels, SGE premium data, mining cost of production estimates, federal fiscal data, M2 money supply figures, and gold-to-silver ratio calculations, are drawn from the original source material and are presented here solely for the purpose of reporting on the analysis itself. Viewers are strongly encouraged to conduct independent research, consult qualified financial and investment professionals, and evaluate all claims against the full range of available data and expert commentary before drawing any conclusions or taking any action. This broadcast does not constitute financial advice of any kind. What the data points cited in tonight's analysis do collectively illustrate, independent of the conclusions the analysis draws from them, is that the global silver market in March 2026 is operating within an environment defined by tightening physical supply, elevated industrial demand, declining registered exchange inventory, significant outstanding short interest, rising production costs, and active institutional accumulation in Asian markets. Whether those conditions produce the specific market outcomes the analysis anticipates, or whether they resolve through other mechanisms over a longer time horizon, remains to be seen as Trading Resume's Monday morning and the week ahead unfolds. That is our full report for this evening. We will continue monitoring developments in the silver market, the situation in the Strait of Hormuz, and the broader dynamics of the global commodities complex as this story develops through the trading week ahead. For this broadcast, thank you for watching. Stay informed, stay engaged, and we will see you at the next update.